finance in light of COVID-19. And then post that, we'll open the floor to questions from the audience. Yeah, so for housekeeping, this session will be recorded. And then the other thing that I would hope you can pay attention to is anytime you're not speaking, please have your mic off. And in case you have any questions during the plenary session, kindly chat us. You can just drop in you can drop your comments on the chat. Towards the end of the session, we'll have a question and answers, some time for questions and answers, about 30 minutes. And you can always raise your hand. You have that on your at the far left, at the far right of your screen. You can raise your hand, and then you can ask your question. Alternatively, you can just chat in. You can drop in your question, and then later I'll walk through them to the panelists. Again, keep your mic off, keep your video off if you're not speaking. Yeah, so questions, commentary during the plenary session, you can just drop them again in our chat session. We will only allow the panelists to speak during the plenary session, and then post that we'll have some room for questions. Okay, so I've walked through our program for the day, and I want to invite our first esteemed speaker, who is Mr. Evans Okinyi, who will be speaking on behalf of EAPN. Evans.
Thank you so much, Anthony. Can I confirm that you can hear me?
Yes, we can.
Thank you so much. So my name is Evans Okinyi. I'm the CEO of the East Africa Philanthropy Network. A brief about EAPN. We are a network of trusts and foundations working in East Africa with the aim of mobilizing local resources and effective grant making for sustainable development in East Africa. Most of you are members of EAPN and partners in one way or another. And so today's conversation is very important for us because as an organization, one of the reasons why we exist is to promote building of alliances, partnerships, and collaboration. So for us as a region, for us as a continent, to achieve our SDGs, I think it's paramount for us to seriously reposition ourselves. Funding is decreasing in this continent, basically for two reasons. One, most of the countries are moving to the middle income economies. Our public debts are increasing. And so as EAPN, we are looking at how do we craft strategic alliances? How do we bring on board the private sector, work very closely as philanthropy with the government, and how do we tap into the global and local financial markets for more private capital, to flow into social development. We want to see philanthropy actively involved in the attainment of SDGs. We want to see philanthropy work very closely with other agents of development, the multilaterals, the governments of the region, the private sector in the development ecosystem. Now, COVID-19 has also really exposed the region's development agenda. We see most countries struggling, the funding decreasing. Most funders who are coming from out of the region into this continent are actually now focusing more on their domestic issues because every country is struggling with the menace that we are facing today. And so this calls for us as a continent, as a region, and as the countries represented in this conversation today, that we have to look at different financing models for development. We have to look at innovative approaches to development. We have to work in partnerships. We have to look at some tailored financing models to support our development agenda. And this is why conversation today around blended finance is one of the avenues that we really have to explore as we look at our social investment and really working around social development for the region that we are talking about. And so as EAPN, we want to continually look at ways and avenues through which we can provide knowledge on this specific matter, encouraging the philanthropy sector, our members, our partners, other actors in the development space to take up this opportunity. We want to continually explore avenues in which we can have such platforms like what we are having today so that we can learn. And lastly, as I come to a close, we will and we are really trying the best we can to work with partners that are in this call today as we broker strategic alliances as avenues of promoting blended finance and other models of financing that we will explore as time continues. Thank you so much, all of you. I welcome all of you, and I look forward to a productive conversation ahead. Anthony, over to you.
Thank you so much, Evans. That is Mr. Evans Okenyi, the CEO of the East Africa Philanthropy Network. And next up, we will welcome Dr. Frank Kaswani, CEO of the Africa Venture Philanthropy Alliance, to give us opening remarks. Frank.
Thank you, Anthony. Greetings from Johannesburg. I hope you're all well. And to everyone who's on the call today, thank you so much for making time to join us. This is indeed a very big focus area for not just the continent at large, but specifically for Africans, because this is the decade when we need to be thinking of how do we close the gap in our development targets? How do we make sure that Africa catches up and is not left behind? And as AVPA, we are working to create a platform where we can bring together social investors across the whole continuum of capital, enabling philanthropists and private sector players to be on the same platform for greater collaboration. This whole question of blended finance, and I want to echo Evans's sentiments, is of significance to the continent because we don't have enough capital in our social sector to fund our social needs. Depending on which data you use, Africa needs about $500 billion to $1.2 trillion annually between now and 2030 to meet its SDG goals. And that money we cannot find through the usual channels of either development aid or government funding. So we've got to be creative, we've got to think creatively. And the reality is we need the private sector and the development sector, traditional development sector, to work collaboratively. There's no way we're going to achieve SDGs if we continue to work in silos and separately. So this is part of, I think, a very critical conversation that hopefully will stimulate many of us to start thinking differently, to see our roles differently, and to see that even as private sector players, we have a significant role to play in closing the gap of SDG investing. And I think to that end, we also, as part of these conversations, hopefully will open the eyes to a lot of people to realize that the SDGs are just not about a financing burden, but also present some significant investment opportunities for the private sector. I think if you read the report from Standard Chartered called Opportunities 2030, you'll see that in Africa alone, the SDGs present something like $1.4 trillion worth of business opportunities. So this is hopefully part of the conversation we can build up, and I look forward to the chat as we go along. It will be interesting to also know people who are on the call. So as you come in, please use the chat group to tell us who you are, which organization you're dialing in, you're calling in from, and where you are as well. So use the chat group to kind of get us warmed up. But thank you, Anthony, and I hope we all have a fantastic conversation.
All right, thank you so much. That is Dr. Frank Kaswani, the CEO of AVPA. And then finally, as part of the convention of this session, we had one of our other partners, the National Business Compact on Coronavirus. And the chairperson for the NBCC is here with us. She'll give us her opening remarks. Dr. Mariam Sidibe, welcome.
Thank you very much. A real pleasure to be here with all of you today, esteemed colleagues. Just a little bit about myself. I'm Mariam Sidibe. I'm a senior fellow at Harvard Kennedy School at the Center for Business and Government. I'm also on sabbatical from Unilever, where I have spent 15 years driving the world's largest hand washing programs, amongst many other purpose-led brands. And then I am the newest author of a business book that just came out, which comes out as the #1 business ethics book globally at the moment. So Brands on a Mission, How to Achieve Social Impact and Business Growth for Purpose. But I'm also coming today as the chair of the National Business Compact. And I'm really, really proud of this initiative that we started over on the 16th of March 2020 when the first case was actually announced in Kenya. And I think what's really interesting about this platform that we've created over the last 4 to 5 months, is the ability that we've had in order to attract what I'm calling, a collaboration of forces in a way that we've been able to respond to the crisis meaningfully and supportive as well. So what I want to talk to you about is a little bit talking about what the National Business Compact is and what we've been able to do. So we all know that, prevention measures such as hand washing with soap, keeping distances, wearing masks, it is going to be absolutely critical if we want to win the war in Africa, but also globally. So being able to figure out what we wanted to do was absolutely critical. That what we knew was missing was actually making sure that communications for behavior change is going to be at the center of the conversation. The mission for the National Business Compact is to limit the spread of infections by improving hygiene practices and contribute to protecting lives and livelihoods across Kenya and Africa. So we come under the leadership of the Kenya government and the Ministry of Health, and endorsed by the UN family. What we've done is looked at 3 levels of collaborations, right? To look at really what core philanthropy could actually do. So, philanthropy, and what core business can do, and also obviously policy engagement, which is why, we started this collaboration bringing together soap manufacturers and hygiene companies, because we knew they had something in the long term to want to get to the conversations when you're talking about hygiene and when you're talking about soap and hand washing with soap. So we brought all the soap manufacturers and competing hygiene brands, Unilever, Reckitt Benckiser, Chandaria, EABL, Pwani, EABL, who had reorganized themselves as the sanitizers, PZ Cussen, and Beiersdorf as well. And then the second element for us was about communications, because we wanted to make sure that some of the best communication platforms are part of the conversation, because the task at hand is very much a behavioral task. So once you've enabled access, you are also moving to behavioral communication. And then finally, making sure that we create what we're calling a last mile distribution, which is a combination of distribution networks and companies, as well as, community health workers and NGOs as well. So combining the strength of the COPIAs who are in rural areas, as well as AMREF, for example, and the community health workers. So quite a broad range of stakeholders, ranging from, AMREF to MSK, who's been lending and supporting us from the communication, to some of our digital experts, so BRIC, making sure that we can tap into their matatus and their platform to reach internet, for example, but catalytic funding as well, in terms of helping us to reach and get to where we are, from J&J, from the Swiss Development Corporation, from DFID, from the Sdg Partnership platform, and of course the East Africa Philanthropy Network. So I think that's, for us, has been absolutely critical. So if I go back to some of our principles and how our work has been guided. So obviously we've been committed to impact and long-term behavior change, but we knew right from the start that we wanted to adhere to sustainable market-based solution, because it's not about recreating an entire new business. It's about making sure that we bring value to the current business. We help them to stay resilient, but we also make sure that we are all coming together in solidarity, in what I'm calling empathetic capitalism, of course, to make sure that we are all coming together, bringing the best of what we normally do in our business back into the service or in the fight against COVID-19. So, I think, if you look, collaborations, inclusiveness, transparency has been absolutely critical. So if I look at the 3 areas that we've been actually thinking about, we've been looking at communication, and I've talked about this before. We've looked at access. And so really creating a distribution network, which is a combination of e-commerce companies and NGOs to reach the last mile, and then being a flexible financing instrument to equip the government whenever needed in terms of, quarantine facilities, responding to some of the needs that exist in terms of, sending doctors to Mandera County, or proper disposal of medical waste. So being a bit of that agile instrument facility has been absolutely critical. The kind of progress that we've achieved, and I think it's really important to look at when we talk about really lending, what it means to do blended financing at a scale like this. Obviously we were launched on the 16th of March. We're less than 5 months old. We've raised over $6 million in terms of cash and pro bono and in-kind contributions. Looking at a grant, for example, the latest one that we've gotten via AMREF is DFID and Unilever coming together and combining this with also distribution of products, as well as funding some of the communication. We've initiated a Commercial Corona campaign, which at this point has reached over 15 million people. Over 45% of all households of Kenya have received this message. We've, with the leadership of the Ministry of Health, we've identified 7,000 hand washing hotspots across Kenya, and we've already reached 5,400 of those and distributed public hand washing facilities. Distributed 100,000 masks, 300,000 bars of soap alongside the hand washing hotspots, and obviously been endorsed, quite nationally with a lot of enthusiasm, and we've appeared in a lot of regional global media as well, ranging from Forbes Africa to very regular local coverage as well. I think, when you look at where we are today and what we're trying to do, we've been very lucky that we have a very core governance team members that have been really flexible and agile in their ability to keep us on track, but also give us a bit of guidance. So, if you look at who is in our core governance and team members, we're looking at, Gitinji from CEO AMREF to Marketing Society of Kenya to the UN SDG platform with Ruben and the Red Cross, as well as the Unilever East Africa MD as well. And a couple of really great advisors ranging from the public health sector and WHO. So, talking to Dr. Mweti to Harvard Kennedy School at Jane Nelson, who's been helping us figuring out what is the right type of partnership platform that we need to put in place, to Paul Pullman, to McKinsey, to Business Fights Poverty as well, giving us a global platform. But locally, we can't underestimate the advisors that we had. And Dr. Mwangangi has been one of the top advisors and support for us in terms of helping us chart this way and keep giving us some agility so that we can really mobilize the best of what the businesses can bring, as well as philanthropy and as well as donors. And I think it's this combination that gives this strong platform and the ability in which we were able to react so quickly. And obviously, I can't not mention Sid Chatterjee and UN Resident Coordinator, because what he has been able to do is champion a way in which we can process and make multi-sectoral collaboration work, because he has basically brought the UN family to the table saying, let's make sure that we mobilize the private sector as a response to this. And here's a platform for which there will be a real interest, because we're talking about soap. And here's the government fully aligned and also supportive of this initiative that is mainly in kind, and a lot of really great volunteerism and great coalition of the willing, that people wanted to do something. But now, as we progress, I think it's really important to think about what the next steps are. We've set up the coalition, we've launched some quick wins, we've scaled up the portfolio of intervention, but we're now expanding into new areas and countries. We are thinking now about food security and nutrition. We are thinking about what are we going to do to support school hygiene and COVID prevention program? What are we going to do in our neighboring countries? And we've been in conversations with the government of Tanzania, and we've been in conversation with Uganda as well, setting up a very similar process and partnership. But just to end on this, this is an example of what it means to do blended financing in response to COVID-19 very quickly. We are very, very proud of what we've been able to achieve. It's been quoted already as the blueprint of partnership, in Africa, in terms of the response of COVID-19. And we'd like to do more. And we're really looking forward to this conversation this morning to set the stage on what else can be done. What is the role today of donors, foundations, and core businesses as a way for us to galvanize and get more support moving forward? So absolutely delighted that this conversation is taking place, and honored that you are looking at NBCC as an example of what has been done and what more we can do. Thank you very much today.
Thank you so much, Mariam. Thank you so much. And if you're just joining us, I am Anthony Mugasha, your moderator for the day. We just had introductions and opening remarks from the partners who put this together, Dr. Frank Aswani, the CEO of Africa Philanthropy and Alliance, and the CEO of Africa Venture Philanthropy Alliance. And then we also had Mr. Evans King, the CEO of East Africa Philanthropy Network. And just now, we just had Dr. Mariam Sidibe from the National Business Compact on Coronavirus. And next up, I want to introduce the panelists so that we can then jump into the plenary session. But before we do that, I'll walk through who they are, and then I'll give them a few minutes to just introduce themselves. So our esteemed panelist for the day is one Ms. Nuru Mugambi, who is the Director of Public Affairs and Sustainable Finance at the Kenya Bankers Association. We also have Mr. Arif Nekei, the Senior Advisor, a Senior Advisor at the United Nations Strategic Partnership. He's also the coordinator of the Sdg Partnership platform. We have Dr. Massimo Ngangi, the Chief Administrative Secretary at the Ministry of Health within the Government of Kenya. We also have Mr. William Masiko, the Managing Director at the Rockefeller Foundation here in Africa, and Mr. Pete Wamishe, the Africa Regional Associate, representing Convergence Finance. So I think we could start by having the panelists introduce themselves, and we can start with in whichever order. Ms. Nuru Mugambi, do you want to jump in?
Sure, thank you so much. So it's a pleasure to be here, and it's wonderful to see familiar faces, and it just kind of reinforces the fact that this whole conversation of the future of finance really is about partnerships. So happy to be here and have this conversation. I also see Manu Chandaria is online. Manu, welcome, and thank you for taking the time to be with us. So I work at the Kenya Bankers Association. It's the industry umbrella body that represents 47 member banks. Caritas Microfinance just joined KBA on Monday. And really the purpose of KBA is to advance best practice and industry standards for the banking industry. We're also a lobby and advocacy organization. And within the context of this conversation of blended finance, KBA has been leading the whole conversation of sustainable finance, really working with the banks to build capacity and understanding and appreciation of the importance of sustainable finance. And I'm not sure, Anthony, are we getting into our comments, or it's just a quick hello?
It's well, it's a quick hello. Yeah, it's
okay.
A quick hello. We really appreciate it.
So thank you to everyone who's making time to be with us this morning.
All right. Cool. I think we'll get into the details of what you're doing with KBA during our plenary session. So thank you so much, Nuru. Mr. Arif Nekei, do you mind going on next?
Yes, thank you. Thank you, Anthony. And thanks for the new spin on my surname. It's actually Arif Neki, but Nekei sounds very Kikuyu, so it's fine with me. I'd like to say how delighted I am to be here. I am the Senior Advisor for Strategic Partnerships at the United Nations Resident Coordinator's Office. We have a very large footprint. I think Kenya is blessed with one of the larger footprints of 23 UN agencies and 2 global head offices in Kenya. And so we coordinate the UN delivering as one partnership with the government of Kenya. I'm also the coordinator of the somewhat unique Sdg Partnership platform co-created between the government of Kenya and the UN that brings in multi-stakeholder partnerships, and in fact is another example of how we're blending different types of funding flows, partnerships, and intellectual capital as well. I can say, I think, quite comfortably that in a room full of almost 50 people, I still feel at home. And the reason is that going back 15 years, I was the founding co-chair of the East Africa Philanthropy Network, one of the co-hosts today. I was also very involved, we've been involved with Miriam and team on the National Business Compact from inception. And I'm also on the steering advisory group of the Africa Venture Philanthropy Alliance with Frank and Nancy and team. And also delighted to say that we're I chair the National Advisory Board for Impact Finance, which is looking to break the silos even within the financing networks. And we have the Kenya Bankers Association, Africa Venture Philanthropy Alliance, Convergence, East Africa Private Capital, Venture Capital Association, pensions, cooperatives, social enterprise. So really, it's a very comfortable space, and thank you for the invitation. Delighted to be here.
Thanks so much, Arif. Really appreciate you being here. Let's jump on over to Dr. Massimo Ngangi real quickly.
Thank you, Anthony. My name is Dr. Mercy Mwangangi, and I'm the Chief Administrative Secretary in the Ministry of Health, I guess popularly known as the face of Corona, with my cabinet secretary, Matai Kago. And when we're not dealing with Corona, I'm a health economist and a medical doctor. So my areas of interest, focus on health financing, health architecture frameworks, a lot of work with the National Hospital Insurance Fund, and of course the Universal Healthcare Coverage Program. And I'm delighted to be here today. Happy to see Mr. Arif Neke. I like the new name as well. He's a partner of ours and a thought partner of ours in the Ministry of Health. And then of course, Miriam, who has supported us in the coronavirus response. So happy to be here today and to share government's perspective when it comes to blended financing. Thank you.
Really glad to have you, Mercy. Karibu. Mr. William Masiko, do you mind going next?
Thank you, Anthony. Yeah, my name is William Masiko. I have a unique experience in the sense that I have worked in government, I've worked in the private sector, now in the development sector. So I do see these challenges around blended finance from different perspectives. I've had the honor and a privilege of working with a number of the panelists here today. And really what you do have here, Anthony, and for everyone listening, are the high priests of blended finance. These are the people who are the thought leaders in this space. However, I really do believe that if we are going to make the transformation that Frank talked about and some of the other speakers have talked about here, there really needs to be some big thinking out of the box. And I'm hoping that we're going to get into some of that during the discussion today. At Rockefeller, where I work today, we are, I think, a unique foundation in the sense that, we're focused on trying to find private sector solutions for development challenges. One of the busiest, I say, functions within the foundation is our innovative finance function that looks at early stage, first risk investments in development spaces. We work in food, in energy, and in health, as well as climate change. And in all these, our innovative finance is constantly looking for ways that we can, attract private sector capital for these development challenges. And I hope to talk about some of those today. Thanks.
Fantastic, fantastic. Thank you so much, William. We really appreciate you being here today. Pete, do you want to go next?
Thank you very much, Anthony. My name is Peter Omishre, as you've seen, as Anthony has introduced me. I work for Convergence Blended Finance. We're headquartered in Toronto. We've got 3 offices in Europe. No, we've got 3 offices spanned between Europe, Asia, and Africa. The Africa office obviously is headquartered in Kenya. And what we basically do, we do 3 key things. First thing that we do is that we facilitate capital raises for blended only structures. Currently, we're having a 7 billion amount that we're doing capital raises for. We also warehouse the biggest data, or most comprehensive data with regards to blended finance transactions globally. So we've got around 100 billion worth of transactions around that. And also finally, we also do training.
Pete, we lost Pete. I think we lost Pete for a second. I hope he can all hear me. So as he tries to reconnect, so we'll give him a minute and then potentially just have him back in a few seconds. In the meantime, keep engaging us. Let us know where you're joining us from. We're really excited to have you here. Just comment on the chat. And as mentioned before, please keep your mic off. We're jumping onto the plenary session as soon as Pete is back.
Okay, sorry, a bit of a challenge from an internet perspective. And said finally, so we do training and design funding to various entities. I think I'll leave it as that, and we'll get into the meat of the matter during our plenary session. Thank you.
All right. Thank you so much. It's really an honor to have you all here. Again, that's our plenary session for you guys. Yeah, we can't wait to indulge them. So I want to join, I want to just jump straight to it, and start or kick off the plenary session. And our conversation on the theme for today is blended finance for COVID-19 emergency response, a multi-stakeholder engagement. And that's where we have, representatives from the government, representative from the private sector, representative from the NGO community, and also practitioners. So it's really going to be, we are looking forward to, tapping into how different sectors are thinking about blended finance, and in response to the COVID-19 emergency. Yeah. So to kick us off, I just want to set the stage right. The COVID-19 pandemic seriously undermined the capability of developing countries to achieve the SDGs, East Africa and the larger Africa being on that list. And helping these countries to respond adequately to the healthcare emergency and obviously the economic fallout requires broad range of systemic measures and close international cooperation. And I want to come to Arif and just ask him, could you kindly speak to initiatives within the Sdg Partnerships platform and the broader UN within Kenya that you've been working on to unlock significant private, philanthropic, intellectual, and broadly just innovative finance, and collaborations that are helping to prioritize SDG impact initiatives. Arif.
Thank you very much, Anthony, and happy to kick off. I just want to just preface this with the adoption of the UN Sustainable Development Goals and the renewed focus on private sector capital and expertise. I think that it's clear. I mean, Frank mentioned this. The estimated tab for implementing the SDGs globally is about 4 trillion a year. And Africa is estimated at between 500 billion to 1.2 trillion. It's clear from the SDG financing conference that was held preceding the adoption of the SDGs in 2015 that two key things need to happen. A, we need to try and find more creative ways of unlocking private capital to complement a very constrained public capital. We've seen in Kenya, but in Africa more broadly as well, how public capital is severely constrained, particularly by debt service and recurrent costs. And the other big message that came out was we can't keep operating in the traditional silos. We really need to converge. For countries like Kenya, lower middle income countries where, finally after 57 years of independence, we are weaning ourselves of the eternal dependence on grant funding. We're moving from aid to trade. Most bilaterals are looking for catalytic opportunities to leverage their funds. We need to be thinking about how we can bring in these types of partnerships across public and private, but even within private, let's break the silos across the various players in the financing continuum. So for us, it was very exciting that in September 2017, we reached the point where the Kenya government launched at the UN General Assembly the Sdg Partnership platform. This is a homegrown platform which was developed with the comment that the Kenya government made at the General Assembly, that there's a lot of pledges of collaboration and partnerships at every conference, at every meeting, but there are very few concrete ecosystems on the ground to make them work. How do you get a blended finance partner, a county government, a private sector company, a development partner, an academic and innovative research company to come together around one concrete investment that can sustain itself beyond short-term political and fiscal cycles? So the SDG Partnership platform was created, and this looks at unlocking SDG partnerships, investments, and financing specifically across the Big Four agenda that President Kenyatta launched in December 2017. Subsequently, as we've been running the health window of this platform, we were pleased that a number of partners, including Rockefeller Foundation, and I'm glad that William is here, took a leap of faith and said, yes, looks like this is a great idea, let's get behind it. And in 2.5 years, we were able to unlock about $150 million of concrete investments that are being curated over time. but more importantly, the kinds of partnerships, the honest broker, the trusted broker role that we could play even across county blocks in government, bringing in financiers, bringing in partners, and unblocking and de-risking some of the constraints that oftentimes hold back some of these investments. So I think we would like to think of ourselves as a multi-stakeholder platform, but an action platform, moving from the conceptual to concrete actions. We also were pleased that Philanthropy joined hands, working with East Africa Philanthropy Network. We helped to co-create with partners the Africa Venture Philanthropy Alliance, which has been an important partner. We also stitched together all the financing networks in Kenya, working with the Global Steering Group, and the National Advisory Board for Impact Finance Task Force was established. I currently chair it, and we're hoping to launch this as a fully fledged board in Kenya later this year. And this is with the blessing of the Treasury as well. We were also able to move into food and nutrition security as a second window. Our aspiration is to have $200 million of concrete investment pipelines happening by December 2021, working with across 400 stakeholders and 100 business membership organizations in livestock, crops, and fisheries through the agriculture sector network that we've co-created with the Kenya Private Sector Alliance, the Kenya Chamber of Commerce, the Ministry of Agriculture. So there's a number of networks and public-private partnership platforms that have come around the Sdg Partnership platform that actually create the momentum, the traction, and the scale. I think William alluded to the fact that we need to be thinking outside the box. We need to be thinking about systems, influence, and scale, and not little boutique pilots here. And we've been having boutique pilots in this business of pilotitis for many years in Kenya. How do we move the needle? Even previous to the advent of COVID this year, we were celebrating 5-6 years of GDP growth year on year, but we were not talking about 35% of Kenyans who've still been behind the poverty line 57 years after independence. So we need to also be thinking about inclusive economic growth. We need to be thinking about this shared value proposition of creating wealth and creating impacts simultaneously. And in the principle of leaving no one behind under the SDGs, we need to be thinking about how do we move a lot of their private capital, not just to impactful projects in cities and traditional areas, but moving it to remote rural areas, oftentimes to populations that have been marginalized parts of Kenya. So leaving no one behind is not rocket science. We know where they've been left behind in Kenya. The issue is how do we de-risk and crowd in private sector? And I see that there's great opportunities. Blended finance is one way of doing it. It's not a silver bullet. It's not new. It's been around, but it's got renewed interest, which is exciting. But let's think of other aspects that reinforce what we're trying to do in addition to blended finance, which include policy ramifications, the legal, fiscal, and regulatory opportunities of making Kenya a stronger destination for private capital, thinking about moving beyond short-term fiscal and political cycles so that as we establish projects and initiatives and investments, there is a degree of predictability for investors, both foreign direct investors, but local investors as well, to ensure that we sustain the impacts around employment, around youth, around the types of impacts we want to achieve. So I'll stop there, but I'm delighted that the mood generally now is to be open for business, to be open for multi-stakeholder partnerships, and to try and co-create. And that's wonderful. And we've been very pleased to be doing some excellent initiatives with the Ministry of Health, including supporting Kenya's first development impact bond in health that is currently underway with support from CIF and DFID and others. So I think if you look at Islamic banking, if you look at the kind of innovative financing presentations we made at Sankalp with about 1,200 financiers present, there's no lack of imagination and ingredients. It's just a matter of what I would say coming together. And my clarion call from WEF in Durban is let's drop our egos, logos, and silos and converge for impact. Let's come together. Let's find ways to do that. Thank you.
Thank you so much, Arif. Thank you so much. And I want to pick on something that you just mentioned when you're talking broadly about the the approaches that you're using to respond to COVID-19 as an emergency, and obviously attaining SDGs as a goal. I want to pick on the multi-stakeholder engagement that you talked about, and frame a question to Nuru about the role of the private sector, and in particular the Kenya banking sector. So overall, the private sector has actually been a part and parcel of combating this COVID-19 of late, and its role cannot be overstated. However, the potential to mobilize additional commercial capital for SDGs in developing countries, Kenya in particular, East Africa as a whole, is still, we have a potential, but then the gap is still there. And I want you to speak, to how the role of the Kenya banking sector, the Kenya Bankers Association, and overall the private sector in East Africa, in creating opportunities to attract catalytic capital.
Okay, thanks so much for teeing up that. Indeed, what we're seeing, and maybe I'll just talk broadly first, and then get into the KBA and the local banking industry view. So I think what we need to acknowledge and appreciate is that I think policymakers on the continent have really moved quickly to mitigate the impact of COVID. And we've seen that coming through on two fronts. We've seen governments consolidating their budgets. We've seen central banks working closely with the banking industry and industry associations to see how to open up liquidity while just mitigating risk, so that the economy is still moving despite the reduced productive activity that we are seeing. And I think in Kenya, for example, this collaborative approach, and I think that's going to be the key word that's going to come out of this conversation today. Out of this collaborative approach, what we're seeing, particularly in the financial sector, is that banks are working hand in hand with their customers to really reprice and lower the debt burden. And in Kenya, for example, banks have repriced in excess of 800 billion shillings worth of household and commercial debt. And why that is an important number is because probably by the end of the year, we'll probably hit 1 trillion worth of repriced capital. And that is probably 30 to 50% of the total loan portfolio. And that kind of just shows you how much the economy is being affected by a health crisis. And that has been the epiphany of this whole process and this whole experience. I don't think up until now we fully appreciated as policymakers, as industry, as private sector, how quickly a social crisis can spill over and affect economic growth. And I think this is the first time we're really understanding this. Obviously, those of us on the line are very familiar with sustainability and the 3 dimensions of sustainability. But I think largely we really focused on the economic and environmental dimensions of sustainability. And the social was there, but probably more discussed in civil society and in public sector. Now within the private sector, we're really beginning to see how interconnected the 3 dimensions of sustainability are. And I think there's a greater appreciation within the financial sector about that. And as much as I talk about COVID, I think we need to appreciate that COVID is not the biggest risk that we face as a continent. Of course, climate change is still there, which is why we come back to the SDGs. Just looking at some of the research out there about the economic impact of COVID vis-a-vis the economic impact of climate change, you realize that COVID is probably the impact is about, about 4% of our GDP in Kenya, for example, reduced GDP output, whereas climate change can be as high as 8%. So climate change is 2 times worse than what we're experiencing right now because of COVID. And I think us as policymakers, as financial services sector, we're now beginning to pay attention to the fact that this issue of sustainability, it's not a department, it's a frame of mind, it's a way of practice, and it's deeply affecting issues around the key drivers of our economy. Just kind of looking at how Kenya's economy and most African countries, the way our economies are structured, they're structured broadly informal, and that's our Achilles heel. The fact that our economies are so largely informal, and now we're seeing why we need to move a critical mass from the informal sector to the formal sector because of how interventions, health and social system interventions targeting this mass, this informal sector, really affects our budgets and affects our fiscal viability. I think maybe I'll just touch on examples that we've seen within the banking industry in terms of blended finance. Arif mentioned that this issue is not new, and I tend to agree. Blended finance has been around for a while, and primarily it's been advanced in the financial sector by development finance institutions. A lot of the DFIs that operate on the continent get their capital from multiple sources. They get sovereign money, they get grants, they get high net worth individuals partnering on different programs, foundations like Bill Melinda Gates, regularly MasterCard Foundation regularly partners with DFIs to channel capital into the financial sector for onward lending to the private sector, primarily within the informal economy and also targeting SMEs. And that's really where the blended finance traditionally has been operating through the DFIs largely. But I think because of COVID, the trends that we're seeing now is this collaborative approach where non-profit organizations and foundations are partnering with DFIs and partnering with fintechs and banks and insurance companies as well, increasingly, to really advance and mitigate some of the challenges we're seeing. And this issue of risk mitigation, Arif talked about it, is a key issue, and it's probably one of the key issues that's slowing down the flow of capital into the economy. I say all that, and let me end by ending it on a more positive note. The fact that I think there is a great opportunity for collaboration. I think financial sector is looking and is more willing to partner and collaborate and have conversations about how can we continue flowing capital into the private sector while mitigating our risks. And that's where I think concepts like decentralized systems anchored by mobile telephony really can play a key part in solving not only the COVID, but the SDG issue. And that's kind of what I would call the COVID kairos. Kairos being the window of opportunity that COVID has presented. Thanks.
Fantastic. Thank you so much, Nuru. I want to pick on something that you just said, the need for collaboration in attaining the SDGs and obviously catalyzing capital in the region. And I want to bring in William. And, William, the question for you, around collaboration would be, broadly, like the role of the NGOs in catalyzing capital, just catalyzing or creating the right or the enabling environment for catalytic capital in the region. William, do you want to speak to the role of the NGO sector?
Thank you very much, Anthony, and thank you for the previous speakers for making those excellent points. Yeah, look, I think, I think Arif made some very, very important remarks, but I think the first one that and most important was that blended finance is not new. It's been around for a while. And we have some great pockets of success with blended finance, okay? But if we're going to be transformational and raise the billions of dollars needed to meet the SDGs, we've got to go beyond these pockets of success. And we're going to understand why we don't have, why we only have these pockets of success and none of them are really transformative at a national, regional, or even international level. And I think if I take my experience in the private sector, I look at blended finance opportunities and look at blended finance opportunities as deals, all right? And if you look at some of the way the biggest deals in the world today are structured by the private sector, there's a lot of differentiation between that and what we try to do in the development sector. First of all, deals in the private sector are led by professional deal brokers, deal facilitators, whose interest is in ensuring that the deal is successful. They manage, the deal from beginning to end. They manage the regulators. They manage different stakeholders, and they are rewarded for that. Many of the best in the world are rewarded as a percentage of the transaction size. Okay. Now, if you try to suggest that in a blended finance transaction, you probably would get some looks, particularly from development, us people in the development world, it's like, you should be doing this. This is for the good of society and so on. And yes, people should do that. But the truth of the matter is you're not going to get to transformation if you don't attract the right people to lead these deals. And I think, organizations like Convergence, represented here by Peter, doing a great job in trying to do these deals. And I'm sure we'll hear from Peter on some of the examples that he's working on. But we need, 100 convergences to be working just in Africa to get the level of capital that we need to solve the challenges that we have. So that's the first point, I think, that is lacking. You asked me about the NGO sector specifically, but I'm thinking this is a challenge we have in development. Mm-hmm. The second thing is, if we are looking at blended finance opportunities as deals, okay? The reason deals are successful, or those that are successful, not all of them are successful, but if you look at some of the biggest mergers in the world and the ones that have been highly successful, is that they are created in places where, the market is developed to a level where it can absorb that capital. All right. So if we want blended finance opportunities to have the same rate of success, we've got to address the market failures. And I think that Arif talked about making sure that the policy environment was well structured, the enabling environment to allow these things to take place are well structured. I think, from a regulatory perspective, if you look at the Kenya Bankers Association, banks in Kenya, very, very highly regulated. And there are some opportunities they might not be able to get into blended finance because of regulations. So how much do we need to look at the market structure that allows commercial institutions to do what they traditionally don't do to allow blended finance to work? So I think that would also be another place that we could think about if we want to get to transformation. And the third and last point that I wanted to make was the other idea around looking at blended finance opportunities as deals is that each of these deals is trying to address a gap in the market. So whether it's an innovation or it's a merger between two companies trying to create some efficiencies, all they're trying to do is to address a gap in the market to get a commercial return. Now, perhaps there is a way that we could look at the challenges posed by the objectives under the SDGs and list those that have a commercial opportunity. What are those that have a commercial return, and what are those that have successfully been demonstrated in other parts of the world to be commercially viable? All right, and say, all right, here's a list of things that could be commercially viable. What is preventing them from being commercial opportunities today, and how can the development sector, NGOs, philanthropies like ourselves help to de-risk? Because largely the problem is risk, and especially in an area such as health, and especially in a pandemic such as COVID-19, which is an emergency response. Okay, so what parts of this pandemic can be addressed commercially, and what parts of those should properly be addressed by philanthropy and development capital from government and DFIs? Okay, so because not all solutions will be commercially viable, some of them will not. So it's about, again, having these deal brokers, who understand everybody's role, make sure that everybody's incentives are properly packaged and everybody understands what their role is in the deal. And I think we will begin to get into transformation. Thank you so much, Anthony.
Thank you so much, William. I think I like the way you framed it. If we think of blended finance as just the normal traditional deals, then there might be reason to then think through their viability and probably their structuring so that we can attract or probably enable more catalytic financing. And I think I will get to Pete in a minute so that he can speak from the practitioner perspective, especially the deal structuring and what he's seeing in the market. But I want to go to Dr. Massimo Ngangi first so that she can speak specifically to the healthcare space. If there's one space that is constantly in our minds today because of COVID-19 is the state of the healthcare, the state of healthcare in our country today. And the country is still grappling with a myriad of challenges, actually not a myriad, like multiple challenges within the entire healthcare value chain that hamper the achievement of SDG 3. And yeah, COVID-19 has probably just exacerbated those challenges. And I'm curious what Dr. Mercy Mwangangi has to say about how the government is rethinking, or how the Ministry of Health is rethinking, or broadly the public sector rethinking healthcare financing, including the place of blended finance.
Thank you. Thank you, Anthony. Indeed, COVID-19 has made it, how do I say, has sort of opened up our eyes as to the critical role that the health sector plays when it comes to economic development of the country, when it comes to the social development of a country. And I must say, you know, listening to all the speakers today, indeed, there's a key role of blended finance when it comes to, you know, further pushing our goals and trying to hit our targets and our indicators. And I think one important thing to always remember, and particularly with a bias on the health sector, is that we always have to think about what the end result is and what the outcome is. And so when you're financing the health system, the idea is that you're putting in resources to buy a certain health outcome. And the health outcome is, you know, of course, good health, you know, healthy people, a healthy population that then contributes to the well-being of the country. And so if we could just dial it back and go back to basics when it comes to financing the health system, we always talk of three key functions, you know, resource generation or revenue generation. We talk then of pooling, and we talk of strategic purchasing. And when I was trying to get ready for this webinar, you know, and trying to put the place of, you know, blended finance and where it fits into this sort of three, you know, normative pillars of financing a health system, it becomes interesting to learn that perhaps this instrument can actually be used to meet the merits of the three main functions of health financing. And you know, when you look to, say, perhaps revenue generation, gaps have been identified in the Ministry of Health. We've been able to conduct year on year what we call national health accounts. And these accounts have been able to paint for us a picture what it looks like in terms of total health expenditures in the country. So for example, we know that primarily the main sources or the main drivers of financing in the system would be government. Government spends around 33% of resources trying to, you know, finance health. We have households spending another about 30% again of total health expenditure again to finance health. And then of course we have, you know, partners and DA assistance, so development assistance, sort of again having an equal proportion of about 34%. Now, every time we're trying to ask ourselves, and we've always had an interesting conversation in the ministry, that we currently have about 400 billion Kenya shillings circulating each year in the health sector. That's a lot of money. The question always becomes then, is this money actually buying outcome X? And most importantly, knowing all the different should I say, aspirations that we have when it comes to financing the system, we still realize that we have another big gap, X, of another billion Kenya shillings that we need to be able to get to, you know, the proper outcomes that we're chasing. And so in the sector, you know, we've debated on this. We've had different, how do I say, thought processes as to how can we better configure the health financing architecture in Kenya. Primarily, I'm sure you're all aware the merits of the third SDG, you know, health for all. That's the tenet of what UHC is all about, you know, ensuring that every citizen does have access to the essential services that they require. And so what we've done in the ministry, and I'm glad that, you know, all the speakers today have talked about this policy framework and enabling space and environment to be able to actually use all the different instruments to generate more resources for health, is that we're putting together what is known as a health financing framework, a policy document. And literally this is a document that relooks at the health space, relooks at our, should I say, normative financing pillars and spaces and flows, and asks critical questions as to whether we are actually enabling the purchase of those health outcomes. And we hope that through the finalization of this framework, and really it is final and should be launched anytime soon, we'll have better clarity when it comes to where we are placing our resources, better rationality when it comes to where we're investing our resources, so that we can have good health outcomes. Now, in the recent past, both globally and in Kenya, there's been a lot of discussions as to engaging the private sector more, harnessing on the agility that the private sector presents, and of course, finding a duplicative, how do I say, an additive role of philanthropy and all the resources that are there in the system towards these health outcomes. And in Kenya, we've tinkered around with, and Mr. Arif talked of little pilots. We have, yes, guilty as charged, tinkered around with different pilot exercises to see how we could be able to, harness these resources. Through the Sdg platform, there've been various interventions when it comes to service delivery models. Is there a space for private sector participation when it comes to primary healthcare? So I'm talking about service delivery at the dispensary and at the health center level. And we've done different pilots and exercises and iterations of how this would work. How do we bring in government resourcing and compound it with private sector resourcing to get a good outcome at the primary healthcare level? And we have good results there. We have lessons that we've learned as to how we can do it better. And again, as part of this financing strategy, once the document is ready, I'm happy to share it with members here. It will give you, thoughts and processes as to what government sees in terms of the future of, blended finance. We've also looked at different other examples, particularly this was mentioned earlier, a social impact bond with CIF. We've seen some, good moderate success when it came to the green bond that, that was floated, I think was last year. We've had discussions as to how we can leverage on this as part of the UHC scheme. So providing that insurance cover and finding a way of how we can then leverage on private sector resourcing. And particularly this is of key interest to the president. So we're looking at a model where we would have government coming in to pay subsidies, health insurance subsidies, having a DP support coming in to compound that, but also approaching philanthropy to come in and help us in sort of bringing that basket together, but then also bringing with it, greater governance, greater accountability, greater transparency, and agility in terms of response. And then perhaps today, narrowing back to COVID-19, there've been, amazing lessons that have been learned. A key important area globally now is public health security. And the very nature of emergencies, occurrences that come about without, being planned for or being foreseen, then sort of require a very agile, a very flexible manner of financing them. And so again, within the ministry, we are looking to see within the ministry, how do we better finance public health security issues, but then outside of the ministry as part of public finance management. Are our laws and our frameworks, flexible but yet accountable enough to be able to give you that quick response that you require, but in a manner that is accountable? And again, that's a space where, as demonstrated through the private sector COVID fund, there'd be a space for philanthropy and DPs to come in and sort of create that sort of platform that has those merits. And so there's a lot of hope that blended financing brings in, but with this, of course, we've seen different, should I say, challenges or, different, should I say, antagonistic views, particularly when it comes to the idea of bringing about market distortions by having a lot of private sector engagement in health. And I'm glad that I think there's a panelist who was able to, from Rockefeller, he was able to sort of talk about the market failures that come about when you're looking at the health sector. And perhaps those are the things that we would need to think about when we're really trying to understand how do we leverage on this? How do we ensure we still meet the merits of what health is and looking at health as a public good, but then also ensuring some crowding in of private sector investment. But most importantly also, and this is always a risk, and we've seen it in different spaces in health, particularly in the just concluded UHC pilot exercise, the idea of needing to really be very keen to avoid fungibility. So every time you have increased investments coming in the health space, there's always a risk of disinvestment by government. And so it becomes very important to ensure that this framework, allows for a catalytic effect as opposed to a disinvestment or a crowding out of government resources. And that's always a risk when it comes to, such instruments. That being said, we remain optimistic. We think this is a tool that can be utilized, and we've seen it work, in the Sdg platform, in the COVID-19 fund, particularly the private sector fund was very agile in providing PPEs and other needed, interventions for COVID. Through the NBCC, that's been a fantastic success story. We've been able to do a lot of work, setting up a lot of hand washing stations, driving primarily the early risk communication response for COVID was purely an NBCC effort. And so that has been successful. And we do look, to, further utilizing the merits of blended finance. I think I'll stop here. There's probably tons and tons of questions, and I'll, continue answering them in the chat. And thank you so much for this opportunity.
Fantastic. Thank you so much, Dr. Massimo Ngangi. Speaking there broadly about COVID-19, blended finance, and the healthcare space as a whole. So just some quick check-in. You can drop in your questions in the chat box. You can direct them to a particular panelist, to the entire panel, and yeah, as we continue on with our panel conversation. Next up, I would want to bring Pete, but just before we bring Pete to speak to the practice of blended finance, I think Pete, every other panelist is saying blended finance is not a new thing, yet the penetration of blended finance instruments is actually quite low. And there might be impediments. So I'm curious, what are your thoughts as a practitioner on the structuring and the enablement and potentially the reasons why we don't have as much penetration of blended finance instruments? Pete.
Thanks a lot, Anthony, and thanks a lot for that question. I think the first key thing that I'll mention, as you've said, that it's not a new thing. It reminds me to the first blended transaction, which I was actually party to back in 2011, which was the Lake Turkana wind power transaction, which was actually a blended transaction. But I think the first key aspect, and I think the first step for me to be able to explain that statement, is that we need to understand what blending is first and foremost. So first, blending is basically a structuring approach, which is used to de-risk a transaction in order to attract private sector investment. That is what blending basically is. So you want to bring private sector folks with purely commercial mandates to participate in that transaction. If you do not de-risk the transaction, they will not be, they will actually not see it as a viable transaction to come to. So blending is not an asset class. It's not an investment thesis like impact investment. It's just purely structuring. And within Kenya, Kenya is actually the first country within Africa that when we at Convergence actually try and rank the various transactions which are performed, that actually ranks number one. And the reason behind this is if you compare it to various other jurisdictions, we are looking at the first key thing is that we've got transactions which are extremely bankable or relatively bankable compared to other jurisdictions. And we are also looking at a regulatory framework which, yes, there's room for improvement, but is robust enough to actually bring both private sector players and soft capital providers to the table. But what is key in a blended transaction, or actually for blended transaction to be successful, are actually three key things. So the first thing is that there needs to be some sort of capital leverage. And what that means is that the de-risking ability needs to be such that the private sector is actually attracted to the transaction. In Kenya, since I think the first transaction for blended finance in Kenya was back in 1981, not even 2011. And from then up to today, looking at private on private blending, we're talking about 92 transactions with a notional value roughly of $13 billion. And if you look at those $13 billion, we're talking about 31% from catalytic capital providers. So that we're talking about foundations, NGOs, and donor agencies. So there's quite a bit of activity when we're talking about blended finance or even catalytic activity within the Kenya space. But what is important and what is very key for, and as a key takeaway, is that the transactions need to be bankable. One, without a bankable transaction, no matter how much catalytic capital you put within the transaction, private sector investors look at going concern enterprises. So that's very key. And it's also, I think, important to demystify some key things also, is that blended finance will not change a flawed business plan. So the business plan needs to be also to be solid from the get-go. So just coming back to your question, is that yes, Kenya is a very fertile ground with regards to blended finance transactions. As I've mentioned, is number one. And from a sector perspective, we'll be talking about financial services, agriculture, and health also, which is beginning to come up currently. But let me just pause there and see if there's any follow-up question with regards to what I've said.
Fantastic. Thank you so much, Pete. Thank you for, just laying the ground really for our listeners and participants today on what blended finance is, what an instrument needs to, what you need to have in an instrument to make it attractive, or just a deal to make it attractive. Before I move to Ms. Nuru Mugambi and talk about, to invite her to talk about the incentives then that we need to allude to or to create to encourage the private sector to participate in blended finance instrument, I just want to mention that you can keep participating by asking questions on the chat. I can see a couple of questions coming in. We'll walk through them in a few, and also participate on social media if you want. If you want, on hashtag blended finance EA. That is hashtag blended finance EA. So, Ms. Nuru, I mean, would you want to talk through the incentives then that we need to give the private sector players, just so that they can participate in blended finance instruments, and potentially core examples? I know earlier you talked through the green bond that was done a few months ago, and so that we can have practical examples for our audience as well.
Yeah, sure. So the Acorn Transaction, which is the first certified green bond in East and Central Africa, it closed in October last year, and in January this year was listed on the London Stock Exchange. So we're very happy about that transaction, and hopefully it helped demonstrate the opportunity of impact finance. The team at Acorn did a fantastic job, and I think they had a lot of courage. It was the first time that they came into the market to raise capital publicly, and they were raising it at a point when the bond market, the fixed income market, was basically dry. No activity was happening, and only those pedigree issuers were considering issuing. So first time issuer coming into market when the market is dry that's what I'm saying, it was quite courageous. But again, that transaction demonstrated the need for collaboration and partnership. That transaction was enhanced by Garantco, which came in to help mitigate some of the risks around the operating environment. Of course, the Green Bond Program, which I helped convene, provided the policy framework. We lobbied for 2 years to introduce a withholding tax incentive, and that withholding tax incentive made all the difference for the Acorn transaction. So I think it's just one of those great examples. They were able to raise 4.8 billion, and it was just able to demonstrate why you really need to collaborate across public and private sector if you really want to catalyze and scale up some of these instruments. And when you're talking about incentives, I think I'll touch on two. There's the incentives within the private sector, and I think that's why I'm saying blended finance has existed as long as DFIs have been active in Africa. So a lot of the DFIs that have been active on the continent bring in and crowd in capital. They bring in concessional finance, multilateral loans, they bring in grant money, sovereign grants. So they've been blending finance for a while. So it's just those traditional structures that are new. And within the private sector, in terms of incentivizing activity, particularly in banking and insurance, I think we need more of this activity and really helping bridge that gap, particularly for projects and ideas and concepts that are new. So we need these types of instruments to bridge that proof of concept space. And when that has been bridged, I think that's when you'll see a lot more local finance participating. Same thing for projects that require public-private partnership, high-risk areas, what are considered high-risk areas, for example, energy sector, agri-sector, SME sector. I think that's where when you're able to bring in some of that more patient and sometimes cheaper or free capital, then I think that provides the incentive for structuring to happen. And really now, because of COVID, looking at those sectors that will not recover as quick as we would like them to recover. So those bounce back sectors and the crawl back sectors like real estate, health, some health sectors, education, travel. These are the sectors that I think we really do need some incentives for transactions to happen. Now, switching to the policy side, I think the government, and it's wonderful that we have professionals like Dr. Mwangangi in the policy-making space. The government has a critical role to play to incentivize activity around blended finance, particularly when it comes to signaling. And I'll give some examples on signaling. Just last month, or I should say at the beginning of this month, PS Hinga signaled the market that the government is now interested in green building. And he indicated that from now on, affordable houses must meet the green building standard if the government is to participate in those projects. That is a very important signal that comes through that helps incentivize transactions within the green space. Same thing in terms of how the government is utilizing the billions that we have seen come into the country around COVID. That is a signal how efficient we are, how transparent we are as a state in terms of how we're utilizing some of these funds will make all the difference in the future in terms of how we're able to crowd in more transactions, more partners in this space of blended finance. So the use of data and the dissemination of data is going to be a critical role for the government within this COVID space to play, because it will create and send the right signal to partners in terms of how we're able to utilize funds. And at the same time, I think to us as citizens, and it's not just in Kenya, it's Africa overall, it sends the right signal to citizens in terms of that social contract we have with the government. When we see the government effectively utilizing our resources, then we are more willing to collaborate and partner, be tax compliant and all that. So I think the issue of incentives, it's not just like Arif mentioned, it's not like a one-way highway. I think it's a multiple pronged, it's looking at your cash reserve ratios and risk weighting from the monetary policy side. It's on the fiscal side in terms of how we're utilizing and deploying capital. And I think definitely it's this point I mentioned earlier about the informal economy and risks within that. The risks, the inherent risks within our market structure, I think if we can solve some of these issues, it will help incentivize more transactions coming through.
Thank you so much, Nuru. Thank you so much. Thank you so much. I think that's really important to know. The incentives. You also quoted a couple of examples, the risks that exist, and in light of that, I want to bring in Arif back to the conversation. You know, there's a question that was raised by Maurice Omondi from. Let's see, this is Maurice Omondi from KAFP, and he says that social entrepreneurship is emerging as panacea to solving societal problems. The challenge, however, is that social enterprises are neither pure charity nor pure for-profit organizations, and as such face the challenge of recognition, identity, and funding. How can they then tap funding from philanthropies and other funders to enable them to create desired impact? And maybe as you're answering that question, you can also speak to specific examples within the Sdg Partnership platform that are enabling social enterprises to tap into funding. Arif.
Sure, thank you. Thank you very much for that question, Anthony and Omondi. So, there have been a few high priority, shall I call, enabling environment agendas that many of us have been pursuing, particularly as they relate to the coming closer together of both the non-profit and the for-profit sectors over the last few years. We're beginning to see this nexus of for-profit, not-for-profit spawn some very interesting, innovative social enterprises, blended finance partners, etc., etc. But has our legal, fiscal, and regulatory environment kept up with it? We heard Peter's comment that by and large, it's still functional and it's moving forward well. But of course, there's always room. The biggest room in the world is the room for improvement everywhere. So, but for us, I think the one priority is that today, if I establish a social enterprise, I am not treated any differently in terms of tax incentives and the like as any other regular for-profit company. Irrespective of, I could be doing 80% of my outputs in terms of social impact, and a private sector company could be doing 10%. I'm not treated any differently. And the reason is that we don't have social enterprises established in our legislation as distinct from for-profit companies established by shareholding. So there's a Social Enterprise Society of Kenya, who is a member of our National Advisory Board on Impact Finance. And Peter Olo is the president. And what we have done is we have been working with him and a whole number of stakeholders in this Social Enterprise Society. A draft of the Social Enterprise bill has been written up. A number of global partners have come in and we've looked at a lot of their models. And so this draft is, I think, ready for moving forward. The idea would be to create a certain distinctiveness of what social enterprises look like, and therefore what kind of incentives they should get. This is in parallel with the PBO Act. Of course, we know the whole story about the PBO Act, the Public Benefits Organization Act, which is intended to replace the NGO Act, which still hasn't ever come into force. And there's been a huge lobby over the years to try and have that happen, and there have been bumps along the way. But nonetheless, that also provides very specific incentives for PBOs that want to remain non-profit, but that can provide some kinds of incentives. And thirdly, we have, I talk always about the East Africa Philanthropy Network, the Kenya Philanthropy Forum, 300 foundations and trusts across East Africa, 80 foundations in Kenya. But local foundations are a figment of our imagination. They don't exist because in law, they tend to be either NGOs, trusts, societies, associations, or often companies limited by guarantee. So there is also an effort going on currently, led by the East Africa Philanthropy Network, supported by KCDF and many of our friends, to write a foundations law. And this is supported also by Wings globally, who is an association that supports philanthropy networks. So I think the question is quite valid. We do need to create the right enabling legislation around it. But in the meantime, we've seen a number of partners, both non-profits and for-profits, invest and contribute towards many of these social enterprises. Many of them come in terms of grants, but there are others that come in terms of angel investors, in terms of some level of debt or soft debt or equity. And we've seen some good examples. In terms of other types of examples that Omondi asked about in the chat box, we're working very closely with the Ministry of Health and trying to support a public-private collaboration in Makueni County and one in Isiolo County. And this looks at establishing a blended financing mechanism for what we'd call a viability gap financing to reach sufficient scale to create a public-private health referral model, especially with the advent of UHC. And that's been moving along quite nicely. Our Public-Private Partnership Act has been discussed many times. It's currently being, I think, overhauled. But meanwhile, we do have a dispensation that allows for a process where health PPPs can actually move forward. Primarily, by and large, there have been infrastructure projects on our PPP list. But I think social sector examples are now coming up. And all the way from the Office of the President down, we are having conversations around how do we reform and recast the PPP process to really fast track both the sectors that can come in, the ticket sizes, and the involvement of counties who feel, in many cases, that they have great ideas, but they don't get to the point of investable projects. And how can the PPP process help them? Let me stop there. Thank you.
Thank you so much, Arif. Really appreciate your response and overall commentary. I want to come to Dr. Mwangangi. There's a question to you, but this is from Dr. Manu Chandaria. First off, I hope, Dr. Manu, the examples that are being quoted are actually helpful. I noticed there was another question on the same. Can we quote a few examples? This is from Chipo Chimwanda. So Dr. Mwangi, over to you. I think the question that Dr. Manu raises is, he frames it as, that recently we've had funds coming in for COVID, and probably there has been misappropriation. What are the chances that blended finance, providing any money towards COVID with having a bad taste in supporting COVID? So my take is, how do we incentivize the private sector, the NGO community, different stakeholders to participate in, say, supporting COVID and broadly creating structures for blended financing across the government? How does the public sector then incentivize the private sector? And maybe you could comment broadly and maybe specifically to COVID-19.
Thank you, Anthony, and to Mr. Manu. Indeed, I think that's a concern that most Kenyans have right now, particularly with the reports that have been seen in the media. And yes, that can act as a disincentive in terms of getting private sector engagement and collaboration into resourcing interventions. What is important to note is that, yes, the very nature, and I think we discussed this, and so did Nuru attribute to it, the framework has to be right. The structures in place for this have to be right and have to be clear, have to be accountable, and have to be also very intentional to ensure that any sort of lack of clarity in the whole sort of mechanism would not be present. And what I can say is that, particularly looking at the COVID-19 fund, one, it's becoming important, and perhaps through our own fault, to be able to clarify for Kenyans what the resourcing looks like for COVID-19. We have a COVID-19 private sector fund. So this is a fund that's bringing together private sector resourcing together with government resourcing. And this is the fund through which we've had participation of Mr. Mwangi, the Equity Bank CEO chair, and that whole team that have come in as private sector, coming together in a fund and having government, co-finance the fund. And really, if you look at the setup of the fund, the very idea of having private sector participation in the board, and in the management of the fund is one key facet that really helps in bringing about accountability and transparency. Now, the reports that have been in the media, and I'm not here to perhaps defend because this is a matter that's under investigation, particularly touches on funds that have come in directly from Exchequer, and that's a different fund. And it's important for people to understand that distinction. What we've seen in terms of, how do you put in place structures that then enable this accountability? Success stories are there. One, in the COVID-19 fund that has private sector collaboration and engagement, but two, also into sort of what I'd call future initiatives that we are working on. Looking at the chart, I've had many people ask, give us tangible examples as to what we're really doing in terms of putting in place blended financing mechanism that then is accountable. One, within the second phase of the UHC program, government is setting up what is going to be known as a UHC fund. And this perhaps will be the very first fund of its kind in Kenya, because it will actually have in its management and in its how do I say, governance structure, it will actually have a private sector development partner and also Mwananchi actually sitting in the fund to manage it and to provide oversight for it. And accountability measures will be quite stringent. We are working on this. We are probably in the 5th week right now with Treasury to design this fund and really a new way of doing things differently within the country. So really structure is important. The legal framework to back this up is important. I think transparency is important as well, perhaps beyond just mentioning the word transparency, but also in how you execute business, in how you share information. All those things are very important, how we share data. And so yes, COVID-19 may have put a smear on it in terms of the reports that are in the media. It is a matter that's under investigation. But at the end of the day, I think how you structure the project, how you structure the instrument is very important. And I think, not to preempt, but like I'm saying, we are working on a UHC fund, and this will really be a different way of doing business within the country. I think also what Mr. Arif has mentioned is important. Through Makueni and Isiolo, again, we've had participation of national and county governments in that project. And if you look at the oversight mechanism of that program that is being run, again, very clear participation of all the different stakeholders who are sitting there and making decisions. And it's been a very pleasant experience in terms of how we've been able to manage those two programs there. So yes, noting Mr. Manu's concerns, but saying again, it becomes important in how we co-create that oversight mechanism and structure. Thank you.
Thank you so much, Dr. Mwangangi, for your response and a particular articulation of examples and the way forward, or how you're thinking about the way forward within the side of the government. So I want to jump on to another question, and I'll probably raise this with William Asiko from Rockefeller. So this is from Dr. Munang Richard from UNEP. And the question, so I'll just try to read, I'll try to truncate as much as I can from the question so I can present it to you in a palatable way. So there's 90% of the continent that is, in the informal economy that's still transacting cash. So actually the number is probably like 95%. And, partly with the convenience of mobile money, formal financial structures such as bank accounts are out of reach. I think the number there is about 66% of African adults still don't have bank accounts. And for such actors, building critical credit history, we need them to raise capital, which is a tall order. You would assume, you'd actually presumably. However, they are accounted for in communal cooperatives, which exist in some form, even at the lowest socioeconomic level, in nearly every community in Africa. So his questions are: one, to what extent can we leverage on the low-risk investment financing, where focus is in the informal sector, building on cooperatives that are most accessible to informal sector players? And what would you suggest on how the stimulus packages being issued by the government can be targeted at cushioning cooperatives against liquidity crunches? I think you could speak to the specific question, or broadly just addressing the informal sector with targeting blended finance instruments there. Thank you, William. William, your mic is off. Okay, thank you.
Thank you, Anthony, for that question. I think perhaps there are people who are perhaps more qualified than I to answer this particular question, but I'll speak to it generally. I think
okay.
Nuru would definitely have something to say about this particular point. But before I answer the question, I just want to address this challenge that Manu raised about misappropriation of COVID funds and the challenge with attracting additional private capital or philanthropic capital to the COVID-19 response. And I think many of you on this panel will know that the Rockefeller Foundation was one of the earliest contributors to the country's COVID-19 response. I'm very glad to say that we provided 100 million Kenya shillings to the response very, very early on. We have received a report as to how that money was spent right down to the last dollar. And we have been able to verify within a very short time how this money was spent. So I think it's important to distinguish between the challenges faced in government procurement, which is highly inefficient all over the world. Kenya is not unique in that sense, that government procurement is highly inefficient even in advanced economies, and you do get challenges around this with resources coming from the exchequer and what can be properly governed and accounted for with philanthropic and private sector capital. So just wanted to support Dr. Mwangangi on that particular point. But on the question that's been raised regarding stimulus and banking, it's a pretty broad question. I would answer this by saying, the challenge is not that a lot of, the majority of informal entrepreneurs are unbanked, or that cooperatives are not receiving the finance that they need. I think the challenge is our enabling and regulatory environment that doesn't facilitate, the efficient allocation of resources to these groups or sectors. Cooperatives are an excellent idea of bringing people together, particularly in the agricultural sector, and they have worked very well in some sectors, in others they haven't. So there's been, a notorious reputation with cooperatives, and I just have to say this. I mean, Arif mentioned the idea that tax policy does not distinguish between social enterprises and private sector, and we need to address that. And I agree, because social enterprise needs to grow, but it's a double-edged sword. The fact is that at some point we do want social enterprises to be treated exactly the same as private investment. We do want them to have the governance structures, the right governance structures to attract private sector investment, so that there isn't that distinction. I think there is a period of growth that we have to recognize, that we need to grow these social enterprises to a level where they are they are sufficient in the economy to allow for these blended finance deals to work. And then, we should then treat them, more or less the same. I worked, as I told you, in the private sector, and for part of that, I spent 20 years in the Coca-Cola company. And like Dr. Sidibe's company, Unilever, Coca-Cola is very forward-looking in terms of its social impact. But the challenge that we had, and I'm sure this is the challenge in many other private sector companies, is that social projects were run by the foundation arm of the company. The idea that that is a sustainable model was very tenuous at the time, until projects that are social are taken out of the foundations into the mainstream part of the company. In other words, they have potential to generate revenue for the company at some point, or protect its profit. Then you will begin to see companies at a large scale beginning to do more for society. But right now, and I think there are many companies that do it successfully, transition from something that was started as a social project that then becomes a commercial project. I mean, there are many examples, but Safaricom's M-Pesa is one. There are many myths about how M-Pesa was started, but if you see today, 30% of the company's revenue is from M-Pesa transactions, something that was started as a social good, so I really believe that creating an enabling environment, having regulations around how to allocate resources, and making sure that governance structures are appropriate, even for the informal sector. Many people in the formal sector cannot attract capital, as Nuru will tell you, because they don't have KRA pins, they don't have IDs, they don't have the kind of things that proper KYC requirements are in the financial sector require you to have. So these are the things that we need to address from I think an environment perspective to allow these sort of people to be successful. Thanks.
Thank you so much, William. That's really, really helpful. And I want to bring in Nuru to comment on cooperatives in the informal sector before we bring in Arif to comment on blended financing shortly. So Nuru, do you mind going on commenting on cooperatives in the informal sector?
Sure. So I think it's all about risk management and risk mitigation. So I think we've all seen how Africa, and especially East Africa, we're seeing a lot of investment around fintechs. A lot of startups within the fintech space are setting up, and they are targeting the informal sector, where largely a lot of our cooperatives operate, even though a cooperative is a formal structure, but they largely operate in the quasi-informal sector. And the pointer to the risk within this sector is the pricing. So you'll see, if you look at fintechs, how they price their credit, you'll find some can charge as much as 5% per month. When you annualize it, you see you're paying more than 50% interest rate compared to your commercial finance that operates in the formal sector, where, as William is saying, there's more collateral and there are other risk mitigation aspects to it. So there is a cost associated within the informal sector and within certain spaces where cooperatives operate. But that doesn't mean that there is no opportunity, which I think our colleague is bringing up. There is opportunity, particularly when you leverage on two things, in my opinion. One, on mobile telephony, and two, on what I call peer networks and peer accountability frameworks. So let me give you an example of the mobile issue. So when you look at, for example, the small community-based organizations in the slum areas, for example, they come together and they create their own systems. They create their own education system, they create their own water and sanitation system, and they transact and they trade because they're leveraging on the M-Pesa framework and other mobile platforms. So therefore, that should be appointed to us in terms of the product opportunities and financing opportunities, including blended finance, looking at how do you tap these social systems and these peer networks that are already trading and already transacting, leveraging on decentralized systems where, unfortunately, public sector might not reach them. Now, in the side of youth, and I saw some questions here about how do we tap the youth potential, leveraging on blended finance. The one example that I want to share is Shujaz. I'm sure all of us used to get a copy of Shujaz in our weekend paper, those of us in Kenya, and Well Told Story is the company behind it. And they are the largest network of young people in East Africa. And they are now setting up a fund. And that fund is going to be financing micro businesses, targeting the youth, and then they're also going to be providing technical assistance to the youth. To me, that's a great example. Well Told Story is a great example of how you have a social product or a social project that has galvanized a critical mass, and now they're leveraging on that data, that peer network, that peer accountability to de-risk the capital. So I think there are many other examples, of course. Shujaz is just one of them. But to me, I think those are some of the keys to tapping the informal sector and the cooperative movement. Also because the cooperative movement is also largely within trade and agriculture. And of course, we know how climate change is impacting productivity and quality in that space. So really looking at innovative ways, government has done a good job in terms of introducing the Movable Assets Registry to help diversify the types of collateral that we can use to access capital. And when I looked at some of the data from the Movable Assets Registry, you will find that a lot of the SACCOs are now beginning to look at the registry as a way of de-risking their capital. So I think these are trends that we really need to support, I think, both within the financial sector, but also as government, to really promote awareness around these types of infrastructure like movable assets.
Fantastic, fantastic. Yeah. Thank you. Are you okay? Get fantastic. Get so. Thank you so much, Nuru. I want to bring in Arif to comment on to talk briefly about blended financing. There was a question on specific blended financing. I think instruments or initiatives that are targeted at social programs from the unit. Arif, do you want to jump in?
Yes, thank you very much. I think one additional point which has been alluded to, but maybe I can emphasize a little more from my perspective, is that no single financing instrument can provide a viable long-term solution by itself. So blended financing is great, but it's not a silver bullet, but it can be catalytic. And though the volume of blended finance is increasing, it plays an enhanced role in financing development. We should also highlight the fact that it is ideally used in certain contexts. Financing on commercial terms, in order not to distort long-term markets, should still remain sort of more or less the default approach, so that we're not creating dependence on private sector subsidies. But blended finance is also not a solution for long-term structural issues where permanent subsidies are called for. And where maybe there are gaps in inadequate policies where policy reforms and other aspects need to happen, rather than blended finance being considered as the silver bullet. And where there is a greater public benefit that exceeds the returns to private investors, usually because there's externalities or market failures, affordability constraints, or information deficiencies that prevent dynamic development of the market itself, I think then we can look at a very targeted, limited set of concessional financing. But we do want to encourage long-term sustainable commercial markets. So I think that's kind of a point I'd like to just emphasize, that it's about using it for transitory challenges in the marketplace, and some level of initial de-risking to crowd in, a more scaled up commercial financing. I'd also like to say that it's critical that a specific instrument that's used for blended finance, whether it's debt, equity, or risk-sharing facility, a guarantee product, a performance-based incentive structure, needs to be clearly designed to meet the development challenge at hand. So, this is not a cookie-cutter approach. This is really about designing a very context-specific, a very issue-specific product. And I think Peter alluded to this importance of design when he was introducing himself, and helping markets eventually get to commercial sustainability. So I think we shouldn't see blended finance as being in isolation from the market context. And we should be thinking about other complementary tools, advisory services, regulatory reform, even public sector finance infrastructure improvements. We talked, I think Peter mentioned the Turkana wind power project, but we also know that, the actual infrastructure on transmission and connecting the project to the grid really required a serious public commitment. So I think it's important to also think about those complementary tools and then the kind of transaction advisory supports that are often needed, because it's not always about mega projects. How do we get those mid-level, missing middle projects to the stage where they're investable? And I see a huge gap in transaction advisory supports. And I think that's where, again, there might be opportunities to support. Thank you.
Fantastic. Thank you so much, Arif. Pete, I think I'll be coming on to you. The question for you is, one, there was a question from Dr. Frank Swani, and the question was why, you said earlier Kenya is leading in terms of blended financing. What makes Kenya lead, and what can other markets actually learn from Kenya? And then secondly, Arif has just alluded to something, the fact that there's a huge gap in transactional, there's a gap in transactional support. And I saw someone else mentioning the same thing earlier, the fact, do we have support for CSOs at the grassroots on projects? So Pete, to you, what makes Kenya stand out? Can others learn from that? And then number two, transactional support. Do you think, how do we structure that, and how can we develop that, at East Africa level? Pete?
Okay, thanks a lot, Anthony. For Kenya, the reason why Kenya actually is ranking, high ranking with regards to blended finance transactions, I think it boils down to, a couple of points. So the first point, and we, I think, cannot overlook, is the investment climate that we have within Kenya. We're talking about from the regulatory and the whatnot. All that provides comfort. And remember, here we're talking about comfort to both private sector investors and soft capital providers. So that's the first thing that is very key that the Kenya market provides. The second thing is that there are a lot, if you compare relative to other African markets, we're talking about bankable transactions. It's because you can have the investable climate, but if you don't have a bankable transaction, you're not going to begin to be able to have high number of investments. So we've got a number of bankable investments. Obviously, this is because we've got entrepreneurs who have been skilled enough to be able to identify key target areas or key pain points for would-be customers. And then it's also very key for the blended space or the ability to be talking on the deal table, that all the particular stakeholders know exactly what the counterparty wants. And that's something which cannot be taken for granted. So I, as a private sector investor, need to understand what the donor needs. The donor needs to understand what the private sector wants, and vice versa, and all the other stakeholders. when you're able to perform that clearly and concisely, then that it helps the investment process, and it also reduces the time between a deal origination and conclusion. So you'll find that coupled with a bit of other small matters here, and is what is actually making Kenya number one with regards to blended transactions. But then also, I need to put a caveat there. Yes, it's number one, but if you look at it from an average deal size, I think we're about top 7, because then we'll have Ghana, Nigeria, and the likes, because then we'll have transactions which are infrastructure transactions, health transactions, basically transactions with high notional amounts. But just in terms of the sheer number, then Kenya is. And I think the second question was around the aspect of technical assistance. And technical assistance is extremely key. It's extremely key. It has been key over the years. I think now is when it's beginning to taper out or to plateau. If we look at it from just the type of archetypes, because if you think about blended finance, there are roughly about 4 archetypes. But either you put in concessional capital, you either put in TA, a guarantee, or a design stage grant into it. So TA accounts for around 30% of the archetypes, just roughly behind concessional capital, which is 41%. And concessional capital, we're talking about less capital, which is lower than market priced. So the TA, we've seen a lot of it being used. It's actually provided by both concessional capital providers, and even now at some point you'd find DFIs actually providing it as part of their package in sectors, and this would be done either to assist individuals structure either the fund, because funds are what are typically used. We're talking about 32 to about 40% of the investment vehicles are funds, because a blending structure is bespoke. It's bespoke to each and every transaction. You cannot use a cookie cutter approach. So you need to be intentional when you're actually going to do any sort of capital raise from a blending aspect. And obviously the TA is, apart from that, also used to de-risk various end users. So if you think in the case of an agricultural transaction, TA would typically be used to provide some sort of upskilling or know-how to the farmer. So we're talking about either the farmer will be upskilled in climate smart agriculture, and enabling them to understand what seeds are important to be used. And this basically promoting their agricultural habits to increase, obviously, yield. And at the end of that whole cycle, we're talking about an increased profit. So TA is important. We've seen it's been increasing over the years, just a bit of tapering. I think majority of the folks are now beginning to skew roughly to concessional capital provision, but that is it for now. But it's also very key to mention that given this particular time period, we're talking about COVID time period, we've seen there's been an increase of, obviously, we think about it as a risk-on situation, whereby majority of private sector investors are looking for ways to heavily de-risk transactions, because we, as of now, do not know the magnitude from a pricing perspective of what the COVID would do. So you'd see participation, obviously, from various donors and DFIs from a guarantee perspective, and also heavily trying to de-risk it from a concessional piece. We're talking about fast loss, equity, or junior debt. So you'll see a bit of those particular transactions, but let me just pause it at that and hand it back to you. Thank you.
Wow. Thank you. I mean, that's why, that's why we have you here, Pete, because you give us the practitioner perspective, and just identify the areas of, potentially where efforts should actually be focused. So I noticed that we've had, great engagement on the chat platform. So this is really commendable. So I also noticed that most of the examples, or rather most of the participants or the panel has actually shared a lot of examples. of blended financing instruments and examples of projects in the country and globally. So that's really good. I also want to be cognizant of our time. We should wind up. That's as much as you have for today. I can see our panelists are over the edge of their seats with the excitement, and I just want to be aware that we will have this as a series. We might have another session in a few weeks, and yeah, we're happy to engage you again. So I want to invite Nancy to just give us a closing remarks and a vote of thanks and the way forward. Nancy.
Thank you very much, Anthony. And thank you to all our esteemed panelists today. My name is Nancy Cairo. I am the Executive Director for AVPA East Africa region. You heard from my CEO a bit earlier. I just want to take this opportunity to thank everybody who's participated today. It's been a 2-hour session, very robust discussion. We've heard that blended finance is not new. However, there are some challenges that we still need to face. William in particular said we need to have, we need to think outside of the box when we're looking at how do we blend catalytic capital, how do we collaborate, how do we work together to meet our SDGs. Nuru talked about signals from government that are very necessary. She also mentioned that, you know, COVID-19 is the current challenge on hand, but there are bigger challenges, one of which is climate change. And these are challenges that are with us and could be with us for years to come. We also talked about the need for robust and flexible regulatory environment and policy change. So I think that this discussion has just really just touched the tip of the iceberg today, and we could go on, but we want to be mindful of time. But we also had some wonderful examples of where blended finance has worked. Peter has given us some great encouraging data. So I thank the panelists, and I'd love to hear from everybody to find out what they'd like to you know, how they'd like us to continue this series. We'd love to hear from all the panelists and the audience what you would like to hear next. You know, what topics should we discuss next? If you want to go into blended finance a little deeper, or other topics, we're here, we're listening, and we'd love to provide the platform for such discussions. I would be remiss if I didn't thank also all of our partners today who have made this event possible. That's Dr. Sidibe from the National Business Compact for Coronavirus, East Africa Philanthropy Network, Evans and his team, and Convergence Finance. We've also had a lot of input and support from USADF. The USADF is actually one of AVPA's largest sponsors. So I would like to thank USADF for their funds, and Dr. Manu Chandaria is a big supporter of AVPA. One of the things I'd like to mention at this point is that some of the discussions around how do we accelerate the learning across Africa, how do we address policy issues, those are some of the things that AVPA is ready to tackle alongside our partners. We have partners in Asia and Europe and Latin America. It's a growing global movement for venture philanthropy. And with those partners, we believe we'd be able to accelerate learning across Africa by looking at what what are the successes that we've seen in Asia, in parts of Asia, Europe, and Latin America. So on that note, thank you very much. It's 1 minute past 12. So I thank everybody and just hope you have a wonderful rest of the day. Please keep engaging with us. Thank you, Anthony, for being a wonderful moderator.
Thank you so much, Nancy. Thank you, everybody. Have a nice one.
Bye.
Thank you.
Bye-bye.
Bye.
Bye. Bye. Thanks. Bye.
Bye-bye.
Thanks.